On Friday, January 30th, 2026, the world's oldest safe haven assets experienced a financial shockwave not seen in a generation. In a single trading day, the price of gold tumbled by 9%, and silver, the more volatile of the two precious metals, plunged by a staggering 27%. This was not a slow bleed, but a sudden, violent, and historic correction. For gold, it was the largest one-day percentage drop since the early 1980s. For silver, the collapse was the steepest since the infamous Silver Thursday of 1980, when the speculative bubble, driven by the Hunt brothers, finally burst. The catalyst for this extraordinary market event was a single political announcement. President Donald Trump has intention to nominate former Federal Reserve Governor Kevin Warsh as the next chair of the Federal Reserve, succeeding Jerome Powell when his term expires in May 2026. The question for investors, analysts, and policymakers is not just what happened, but why a single name could trigger a multi-trillion-dollar unwinding of the precious metals market. The answer lies in the complex, often contradictory reputation of the man chosen to lead the world's most powerful central bank, and the deeply speculative nature of the market that had formed around the very idea of a politically compromised Fed. This is the story of how the fear of inflation, the lure of speculation, and the shadow of a financial hawk converged to create a crash for the history books. To understand the crash, we must first understand the fever that preceded it. The sharp decline on January 30th, 2026, was a direct and brutal reversal of a massive year-long rally. Just one day earlier, on January 29th, 2026, gold had traded near its all-time high of approximately $5,600 per ounce, and silver had soared to an unprecedented $121 per ounce. This rally was not driven by traditional industrial demand or a sudden surge in jewelry buying. It was fueled by a macroeconomic narrative known as the debasement trade. This bullish interpretation of the market held that the US dollar was on an inevitable path to devaluation, driven by a toxic mix of factors: soaring US national debt, persistent geopolitical instability, and, crucially, the expectation of a Federal Reserve that would prioritize political expediency over monetary discipline. Investors poured into gold and silver as a hedge against this perceived financial recklessness. The metals were seen as the only true, real money in a world of fiat currency and digital assets. This sentiment was amplified by the highly speculative nature of the silver market, which saw massive inflows from retail traders, echoing the meme stock phenomenon of 2021. Analysts noted that the market had become dangerously thin, meaning that even modest inflows could trigger outsized gains, leaving prices detached from physical demand. This speculative fervor created a powder keg, and all it needed was a spark. The spark arrived in the form of Kevin Warsh. His nomination immediately injected a dose of reality into the market's inflation-driven narrative. Warsh, a former Fed governor from 2006 to 2011, is a figure of deep contradiction in modern monetary policy. His historical track record is that of a staunch inflation hawk. During his tenure at the Fed, he was a vocal critic of the central bank's initial quantitative easing programs, frequently expressing concern that the massive expansion of the Fed's balance sheet would unleash runaway inflation. He was a key figure during the 2008 financial crisis, acting as a crucial liaison between the Fed and Wall Street, but his policy stance was one of caution against excessive stimulus. However, in the years leading up to his nomination, Warsh appeared to soften his hawkish edge. He began to advocate for lower interest rates, aligning with the Trump administration's desire for cheaper borrowing costs. His argument was rooted in a belief that technological advancements, particularly in artificial intelligence, would unleash a massive disinflationary productivity boom, rendering the Fed's current rate-setting framework obsolete. This created a schism in market interpretation. The bullish case for gold and silver had been built on the expectation of a politically compliant Fed chair who would aggressively cut rates and ignore the balance sheet. Warsh's nomination, despite his recent dovish comments on rates, signaled something far more complex and, for precious metals, far more dangerous. The market's immediate reaction was to focus on Warsh's most consistent and hawkish policy stance, his deep-seated criticism of the Federal Reserve's bloated balance sheet. Quantitative easing, or QE, is the process by which the Fed purchases long-term securities to lower long-term interest rates and inject liquidity into the financial system. The reverse process, quantitative tightening, or QT, involves shrinking the balance sheet. Warsh has long argued that the Fed's balance sheet, which ballooned to trillions of dollars following the 2008 crisis, and again during the 2020 pandemic, is a source of financial instability and a distortion of capital markets. In a November 2025 op-ed, Warsh reiterated his view that the Fed's bloated balance sheet could and should be reduced significantly. This is the key difference from the perceived status quo under Powell. While Powell had also engaged in QT, Warsh's reputation suggests a more aggressive, disciplined, and systematic approach to shrinking the Fed's holdings. For the precious metals market, this was a death knell for the debasement trade, a commitment to balance sheet reduction signals, a central bank focused on draining liquidity, not flooding the system. It suggests a return to monetary orthodoxy and a defense of the dollar's value. The nomination of a credible, if controversial, policymaker like Warsh eased the market's deepest fear, that the Fed's independence was entirely compromised. The most immediate and powerful mechanism of the crash was the sudden, sharp strengthening of the U.S. dollar index, or DXY. Precious metals and the U.S. dollar share a fundamental inverse relationship. Gold is priced in dollars, and when the dollar strengthens, it takes fewer dollars to buy an ounce of gold, thus pushing the price down. Conversely, a weakening dollar makes gold cheaper for foreign buyers, increasing demand and pushing the price up. The pre-crash rally in gold and silver had been accompanied by a period of dollar weakness, driven by the same fears of U.S. fiscal and monetary indiscipline. Warsh's nomination instantly reversed this trend. The market interpreted his appointment as a signal that the U.S. would not pursue a policy of deliberate currency debasement. As a result, the DXY surged, and the safe haven trade that had been betting against the dollar evaporated. This dynamic was particularly devastating for silver. Silver's dual identity as both a monetary metal and an industrial commodity makes it inherently more volatile than gold. Its price movements are often amplified by speculative flows, and when the market turns, the leverage works in reverse. The 27% single-day plunge in silver compared to the 9% drop in gold highlights the extent of the speculative positioning that had built up in the silver futures market. The severity of the 2026 crash demands a look back at history, specifically the two most comparable events, the 1980 silver crash and the 2013 gold crash. The 1980 event was a pure speculative bubble. The Hunt brothers attempted to corner the silver market, driving the price from under $2 per ounce in 1973 to a peak of $48.70 in January 1980. When the COMEX changed its rules and the brothers defaulted on margin calls, the price collapsed, falling by over 50% in a matter of weeks. The 2026 silver crash, while triggered by a policy announcement, shared the same underlying characteristic, a market saturated with speculative leverage that was forced to liquidate all at once. The 2013 gold crash, where the price fell by 30% over a few months, was a direct response to Federal Reserve policy. In May 2013, then Fed Chair Ben Bernanke hinted at the possibility of tapering the Fed's quantitative easing program. This talk of withdrawing stimulus signaled an end to the easy money era, causing a massive sell-off in gold, which thrives on easy money and inflation fears. The 2026 crash is a compressed, more violent version of the 2013 event, where the expectation of a more disciplined Fed chair achieved the same result in a single day. The immediate market reaction has clarified the stakes, but the long-term implications of a Warsh-led Fed are far from certain. The new chair will walk a tightrope between his historical hawkishness and the political pressures of the administration that appointed him. The bearish case for metals. The primary bearish argument is that Warsh will aggressively pursue balance sheet reduction, draining liquidity from the system and strengthening the dollar. Furthermore, if his belief in an AI-driven productivity boom proves correct, the U.S. economy could enter a period of disinflationary growth, removing the core rationale for holding gold as an inflation hedge. This scenario suggests that the recent highs were the final gasp of a speculative bubble, and prices will continue to correct back toward historical norms. The bullish counterargument. The counterargument for precious metals remains rooted in fiscal reality. The U.S. debt trajectory is unchanged by the Fed chair. The national debt continues to climb, and the cost of servicing that debt is rising. A Warsh-led Fed that aggressively shrinks the balance sheet could inadvertently trigger a recession by tightening financial conditions too quickly. In a recessionary environment, gold and silver could resume their safe haven role, especially if the Fed is forced to reverse course and cut rates to stimulate the economy. Furthermore, the political pressure from the White House for lower rates remains a constant, and Warsh may find his hands tied, forcing him to compromise his hawkish principles. The 2026 precious metals crash serves as a stark reminder of the power of central bank credibility and the danger of speculative excess. The market had priced in a worst-case scenario for monetary policy, a Fed that would willingly debase the currency. When a credible figure was nominated, even one with a complex and evolving policy view, the fear trade collapsed. For investors, the lesson is clear. Gold and silver are not just hedges against inflation, they are also a bet against the US dollar and the stability of the Federal Reserve. The 9% drop in gold and the 27% plunge in silver, while painful, have simply corrected a market that had become dangerously overextended. Even after the carnage, gold remains up 14% and silver up 22% for the year, demonstrating the underlying strength of the long-term trend. But the ease with which a single name, Kevin Warsh, shattered the speculative bubble proves that in the world of finance, liquidity, and the perception of monetary discipline will always trump the fever of fear. The question now is whether the new Fed chair can maintain that perception, or if the underlying economic pressures will force the market to once again reach for the ultimate safe haven.